Hello traders, welcome to FreeFX. My name is Francesco and today we're going to discuss the S&P. We've got lots of things to go through, so without further ado, let me start with this. So this chart is the futures S&P E-minis September 2022 from CME. You can see I've got lots of things there. First of all, the price on top, we've got 200-day moving average sitting here, and then we've got volume bars, and then below that two indicators. So just kind of going through that, what you can see straight away is that we have had this rejection of the 200-day moving average, simple moving average, SMA. Today it's been kind of confirmed. So through the week, from my last video on Monday, we've had a number of interpretations of what the scenario, how it might play out. Will we go and break above the 200-day moving average or below? As it happens, obviously we have actually broken down, so that's obviously resistance, and that took basically the whole week. As you can see, 1, 2, 3, 4, 5 days for that to play out fully. Now today's candle is not to be scoffed at, because actually it was quite a strong move. If you look back, it's one of the strongest moves we had as a single daily candle. It's a pretty comprehensively resounding kind of victory for any kind of self-respecting bear, as you can see. So today the high was 4288 and the low 4220. So like 68 points, pretty good. Although obviously kind of quite narrow ranges. Yesterday was a very narrow range, as you can see. So compare yesterday, 4295 the high, 4258 the low, even narrower. So. But today was a pretty solid candle, not much of a wick anywhere compared to, say, the 11th of August, as you can see, almost a perfect doji there. And that's really good because we actually need to have some kind of conviction. That move as well as telling us that the 200-day moving average acts as resistance. Also, it starts next week as something quite strong, because we have a number of events on the docket. And also, if we look at these indicators here, you might appreciate that they're quite similar, and I'll obviously highlight that in a second. So let's take a look at the CCI Commodity Channel Index, the 21 period, and you can see that as I've highlighted before, we've had this divergence in price. So we had these rising humps. Started counting from here, 1, so above the 0 level, that's a 0 level line, dash line. So 1, 2, and 3. When we got to the third, I started sort of wondering if we might get some divergence, and sort of having a few thoughts about that. So as you can see, price went higher and higher and higher, and at the second and third humps, we actually had kind of leveling off or leveling out of the CCI just under the 200 level, and then we started coming off. Slight pickup here from the 9th to the 10th into the 11th, but not really following price. And then finally this week we've had price conforming and the CCI negative divergence actually confirmed. So when we have that scenario, obviously the important thing is that price confirms, and unfortunately that can take some time, as you can see. Now, interestingly, the rate of change indicator that you see here, I put it as a 21 as well for conformity, and the movement is very similar on the daily anyway, and so it doesn't really add any more information. Now, it is slightly different because we had a move higher, as you can see, on these two levels. There's been a move higher, which is kind of where we got to this week, but then eventually the outcome is the same. So what it's not showing you is divergence, whereas the CCI does show you that. It's calculated differently. So I would basically go and take out this indicator there. This is not really helpful. My filter for the CCI is always the 200, and you might actually consider again that every time we come to the 200, we tend to have it rejected. So previously we had a move higher. This is very important, by the way, in March, and that took about, let's say, 2 weeks to play out, and then break down again below the 200 SMA, simple moving average. However, the divergence started earlier. So as you can see from the 22nd of March, we had this descending move, but it only really price confirmed to that only later on. We're talking about the 8th of April, and then further down. So the 200 is a very important mark, and when we start seeing price moving away, or CCI moving away from it and price not conforming, it's a sign usually, not always, but it's kind of worth bearing that in mind. And this is very important. When does it work and when does it work? And there's money on the table, so it's not really an easy thing to do, was deciding in the moment, on the go, whether price is right or the divergence is right. So just kind of bearing that in mind, I'm just going to close this because we've kind of explained all that, and I'm just more interested in moving on to the next topic. So this was the futures, and very important for the futures because you have centralized volume, and I don't know if you saw on that chart, the bars volume didn't really pick up today that much. We've had a sort of slew of days with kind of descending, sloping volume, and we were kind of waiting for that to pick up. So we haven't really had that surge in volume, and seeing the graph really with seasonality from John Kicklighter, it's really difficult for August to provide that kind of volume that might be needed for trends to develop, either continuing trends maybe, or reversal of trends, or after some chop, a new trend perhaps in the same direction as the previous one. So we are all thinking that September, being almost on the doorstep, might provide that return of professional money managers or funds, or the necessary volume to be there to drive these markets. Now, interestingly, there was a tweet the other day about a famous investor, Stanley Druckenmiller. He was saying that he hasn't really been jumping into, say, short equities, or because he was kind of warning against basically moving into a rally in a bear market, because it can rip your head off. I think those are his words, not mine. And so to be careful, but that he would be looking to, to getting into short. He was just kind of sitting out at the moment. Fund manager, very accomplished financier, shall we say. So it's always good to hear people of that caliber saying I'm staying out, because, and then we had Michael Berry as well, famous from the Big Short, saying I'm out stocks, and basically just holding one stock, but so these are kind of things. And then you've got the volume considerations, obviously. So this lack of big money in, and it all kind of amounts to basically uncertainty. And what we had today was a good day in terms of coming off that technical level, but we need the next leg now, which is a return to momentum into this trend, the overall trend. Now, I showed you this the other day, which is the options heat map, and I was actually highlighting that there was a big change in terms of the puts at, I think it was 4.310. It's around there, and that would equate to where the 200-day simple moving average was. I think it was 4.325 at the time, so not too far off, just a little bit above, but that's changed. Now today it's changed. As you can see, we've got the largest number of puts is actually down now at this level. The biggest change has been an increase into puts at 4260. So a lower number, although it's higher in the list, but it's a lower level in price. So if I show you where 4260 is, it's here. Okay, so this is 4260, just about there, and we had it at 4310 previously, which was about here. Okay, so that obviously has been rejected, and now puts are being called, are being purchased or bought at 4260. Big change there. Now, interestingly, you might notice as well that there are sort of big empty fields, and one thing that's happened is that this week we had expiry of options, different categories. So Tuesday to Wednesday, it was the VIX options expiration. Then through the end of the week, it was ETFs, S&P, for example, etc. So today, part of the move, some said, was due to the options expiry for S&P. I don't know, I wasn't there counting the money. But it might be that's one of the causes for that, and maybe some premium being sold. Because I don't trade options, I can't really comment in detail. So this is a very blunt way of using this tool. But again, it shows you that there's been a move in terms of where the insurance, if you like, has been purchased, or again for speculative purposes, it's moved further down. So again, expectation perhaps is that the price is going to drop further, and so we've moved down with price by 50 points. So let's there are two things I'd like to finish with. First of all, this is the chart. We looked at everything. There's not really been that much of a change. That's the daily there. Obviously, we've had this setup that I was showing you before. We've got 4 highlighted sort of interactions between the ATR at 70, that's your level there, and how we sort of come from October below it to eventually being above it in the new year, with the bear trend starting, growing, easing in April, coming off that 70 level again, and we've come back to it and we just dipped below it. Now, we dipped below it here in January as the bear trend started. We were just dipping below it and then back above. So we're roughly going to stay around that 70 thing, and we're going to pick up as we get more volume and possibly more volatility, more conviction. So I think that's going to pick up there in the next few days, just as it happened here. As always with these things, it's not mathematical that it repeats the same. It could be a few more days. I mean, this decline was very, very slow. Compare, say, to this decline here in March to April. So that's, kind of a couple of weeks. This took from 23rd of May to 17th of August. So nearly 3 months. So obviously that was kind of a slow dribble out, just drifting and into this sort of bear market rally. Unfortunately for you, I'm going to keep calling it bear market rally, because to me, and confirmation seems to be here that it was, until something dramatic happens, I'm going to keep calling it that, because the overall trend seems to be that. Some people have been posting on Twitter the same chart in kind of different ways, but essentially it's an overlap between the 2008 S&P and the 2022, and it sort of shows a similar pattern developing if you overlap them kind of correctly, or in a way that's visually makes it quite clear in a way that they are a very similar pattern. So we are seeing this turn today or this week, and that does sort of line up approximately with what happened in 2008. And I had a look at it as well. We had 2008 didn't have such sort of big bear market rallies. I mean, this one was 17 something percent. Actually, I take it back. I checked just earlier, and we have had these rallies in 2008. We had rallies of 15% and rallies of, equivalent width. So it's not really different in terms of the depth of these rallies. So as much as you can kind of have conjectures about what it means now as opposed to what it meant in 2008. I mean, the movements are similar. So the charts I've seen on Twitter, 2008 and 2022, do look like we are in a similar kind of bear trend, which is why I keep calling this a bear market rally. It's what it appears to be. Now, what is happening next week? Just to finish, I've obviously filtered this to only reflect USD, and it's just medium to high risk kind of event or high impact event. So we start Monday. We have this Chicago Fed National Activity Index. I'm just going to ignore that. Tuesday, we have S&P Global Manufacturing PMI. So it's about the PMIs and home sales. Now, there have been a lot of home sales coming out, new permits, home sales. These figures sort of come out fairly regularly. We don't expect to see a lot of change. As you can see, the consensus for new home sales in July month-to-month, -3%, and it was -8%. So, mild improvement. New home sales, July rather than month-to-month, is 0.5 mil consensus, previous 0.5 mil. So, okay, slight second digit, slightly different, but essentially we are around the same area. Wednesday, however, is going to bring quite a bit of things. So on Wednesday, we've got the not just cash carry speech, but we've had a cash carry before. So not really that market moving. The high event is going to be durable goods and also some, again, home sales, etc. But the durable goods could, be a market mover again. Consensus 0.3, previous 0.4, and without transportation, so X transportation 0.2, previous 0.3. Okay, so a cooling down of durable goods orders. Thursday is going to be interesting because we have GDP growth rate quarter on quarter, which again shows a slowing down. Okay, we have again more jobless claims, but the main thing is the Jackson Hole Economic Symposium, where supposedly we are going to hear something incredibly new from Powell. But I think it's not just about Powell. I think, as always, there is, just like during the 2018-19 pre-COVID, we had this sort of period where central banks were looking at each other. Yellen on one side, Carney for the Bank of England, and Draghi for the ECB, looking at each other and seeing what the conversations were within each bank in terms of, low inflation, so under inflation, wanting to get that up to 2%. That was the target. Now it seems that because we are in a different scenario with inflation, we want to, every country is engaged in this kind of its own war on inflation within their territory, but actually, obviously, it's a better approach with an integrated approach. So I think they are very much different central banks in terms of the mandate, but they will be looking at each other and taking the opportunity to in a way, also provide perhaps reassurance globally that advanced capitalist societies are moving in tandem to tackle inflation, which is a global problem. It isn't just one isolated incident. Of course, we look at Turkey. We are looking at sort of 80% inflation roundabout figure. So there's a scale there, and Turkey is a big player, it's a big economy. So, but if we look at the sort of bloc, US, UK, Europe, they all have similar tools in terms of central banks, rates, support packages, and quantitative easing in the past, and now trying to shrink that amount of money. So some messages might come through that which are supportive of the central banks, the individual central banks' actions, in a way, in a harmonious way between all the different banks, providing a united front. And that could sort of reassure markets in some ways that they know the score. This is what's happening. It isn't just Powell or Kashkari or Daly or George saying, or Bullard saying, oh, we are wanting to raise rates and nobody else is. If the message is central banks are going to fight inflation with all the tools available and just whatever it takes, to quote a famous central banker from ECB days, whatever it takes. So if that means, in a way, cooling demand to the point internally, to the point that it does hurt GDP, that is a concern. But if front-loading the rate hikes is going to avoid mistakes of the past, as it's been quoted, 1970s style, the sort of turning back the clock, but rather front-loading the rate. So again, the narrative is the Fed Watch tool. Looked at that on Monday. The next meeting in September, that 75%, 0.75% rate hike probability has gone right down. But that might pick up again, depending on what message is coming through at the Jackson Hole Symposium. So I think it will be watched. But again, not sure what anything new will come out of Powell's mouth. It'll be more eyes on central banks generally, on what the message is within that. That's my feeling, that's probably what might be important. That continues into Friday again. And then on Friday we have the PCE, which is something that the Federal Reserve Bank also keeps an eye on. So personal income, expenditure, or the deflator, as they call it. And that's also going to be a very important thing. As you can see, the personal income expenditure, personal income month-on-month, July, expected to be the same, consensus and previous. And the personal spending is going to be smaller, 1.1 going to 0.4. The PCE, personal consumption expenditure, is going to be again smaller. So the expectation is a cooling down of consumer spending, which is not good for the economy, but it means that it stops pushing prices up as well. So it's obviously the double-edged sword of the Fed's intervention, which is by making things more expensive centrally, the rate hike. It's sort of counteracting the inflation, but also curbing demand. Things get more expensive, etc., etc. So the cost of lending of credit is more. So people borrow less and stop sort of pushing the credit bubble. That's economics 101. There have been lots of comments on Twitter about how can we support central banks and this crippling the economy, and when they created the inflationary scenario themselves with essentially money printing, but that's a different conversation. To finish the week, on the Friday we also have Federal Reserve Chair Powell speaking at 3 o'clock UK time. I'm not sure if that's as part of the Jackson Hole Symposium. It may well be. I'm just going to click on that because it might be to do with that. I don't have the data on that, I'm afraid. So I take it that it's part of the Jackson Hole Symposium, but it might be separate from that. Anyway, it will be watched, obviously, although you know, it's hard to say. That symposium continues on a Saturday, but obviously the markets will be closed, so and Powell would have had his opportunity to air his thoughts during the market week. So, just to recap, we have an interesting week ahead. The end of this week heralds the start of something new, which is we come off that 200-day moving average. We've got the CCI confirming that negative divergence through price. We have potentially a return of markets into some kind of greater volume as we approach September, gradually move to that time of year where historically the S&P has actually done worse, which again supports the thesis that we are going to see a continuation of a down move. I don't even want to call it a bear market, it's just a down move. We trade it down just like any other trading day or week or month. And we want to call it bear market. Generally that's fine, but it's not the end of investing, or certainly the Federal Reserve can't do anything about a bear market trend. They're doing something quite different, so nobody's going to intervene and stop those red candlesticks appearing on a screen. So unless obviously there is a lot of money floating against that, which seems unlikely at the moment. Possible, everything's possible. So next week is going to be very important for all these reasons. So I urge you to stay tuned onto your charts or whatever you're using to invest, trade, and really this might be the start of a very important week. As always, every week is important, but this is a very good turning point. We've had the turning point, as I mentioned before. You rotate it now into this possibly next leg of the bear trend, which could be, you know, 15%, 17, 19, 20%, 30%. You know, it could go on a few weeks with the odd sort of relief move, but we've had the bear market rally. We talked about it to death, and now it's time to move on to the next stage. So I do hope that if you found this period difficult, this might provide some clarity if you are trading it to the downside. Thanks very much for watching, and I'll see you in my next video on Monday next week. Have a great weekend. Take care.